Hey, what's up guys? This is Jay from swimtrading.com. This is another week of market analysis that I'm going to do with you. So right now we are looking at the chart of Straits Time Index, and this is where I'm from, Singapore. So very quickly, let's look at what's happening on the Straits Time Index. And you can see that Straits Time Index has been on the downtrend for the past few weeks. And this downtrend is pretty fierce, and if you're just looking at horizontal support or resistance, you are in there for quite a rough ride because prices don't just turn there. So where is the next level down? The next level down is somewhere around the round number of 3,000. And right now, you can see that I have a trend line over there. Instead of just looking at 3,000, I'm also looking at a slightly higher level compared to 3K, which is around where the coincidence of the S5 together with my trend line over here, which is the 3060 zone. So in the coming week, I may expect some of the consolidation before it comes down to here eventually, because the market or the economy for Singapore has not been exactly well, and we are only expecting a 1% gain in our GDP for this year. So with that said, the market is going to price in all of this, and whether is it overdone or not, well, we are not an analyst, so we do not know. What we do is we trade, so we look for where the possible turning points are. So the turning points that I can see here, well, if you can see that this one, if it reverses up, where is it going to go? Upside is going to be here, 3180. That's the upside. And if it continue to go down, downside is 3060. So these are my two targets for this week on the Straits Time Index. So shifting up further north, where Hong Kong is, again, Hong Kong market has dropped like almost 20% since the high of 30,000 points for Hang Seng just a few months back. So you can see Hang Seng has dropped from 30,000 plus and all the way down to now is 25,000. It has tested 25,000 and bounced up. Because it's a round number, right? So you can see that it is going down very nicely. If you look at P1 equals to P2, this is your first leg down, okay? This is your P1. It seems to be pretty equivalent with your P2. So what I'm expecting Hang Seng to do this week is a little bit of upside, which some of you may call it as a dead cat bounce. But on the Hang Seng, you look at this. The cat is not dead, you know. Sometimes when it bounces, it can bounce quite high. And it goes on, you know, for 1.5 months before the thing goes down again. So where is it going to go down? Just based on what I see here on the charts, well, if I were to zoom out looking at a bigger picture, you can see that you have a support level over here, which is kind of near the S5, in between S5 and S4. And you can see that the upside, definitely the upside is 26,000 points. So this is what I'm looking at for this week, 26,000 points. Downside, I'm expecting it, if it continues to come down, I wouldn't be surprised if it hits the 24,580 points, which is around 245 or 24600. So that's the downside. And on the upside, it's just probably a dead cat bounce on the 26,000. But then again, Hang Seng will always, you know, surprise me. So with that said, secondary upside 26,500 in the coming week. Alright, so that's for Hang Seng. And moving further east, we have the Germany 30, the DAX, the Germany 30 index. So on the DAX itself, you can see that right now it's also on a downtrend. It has found, if you can term this is like a head and shoulders. You have the head, the shoulder one, and then here's the shoulder two, and then people will say this is the neckline, and a further downside to the neckline. Okay, so this is what the usual textbook stuff would tell you. So how different is my analysis going to be? Well, I would say the upside remains at 11,800 where the S2 is. I don't see much of an upside or much of a, you know, optimism coming out from Europe for the time being. And if anything, it is going to bounce up, okay? And I'm going to watch how it reacts to 11,800 and then for a swing shot down again. And where is my eventual downside? My eventual downside, I am looking at the S4 area, which is around 11,100. So can this happen in the next week? I don't think so, but over the next 2-3 weeks, this should happen. So immediately we are bounded by 11,500 or 450 over here, and upside is 11,800. So there's a range of 400 points. Am I expecting volatility? Yes, I'm expecting volatility. So what kind of strategies would be most effective in such volatile days? Day trading. If you're looking at if you're looking at swing trading for this, then potentially you are looking at some very nice days, swing, and then after that one day will just wipe out all the rest of your swing. So when the market conditions exhibit such a behavior for me, what I prefer to do is to do day trades. Okay, and besides, the range qualifies for it. You can see for the last trading session, we have 1.44% on S&P, we have 1.3% on DAX, we have almost 1% on Hang Seng. And yeah, if you're only having days like 0.7% like what you're seeing in Singapore market, that's not the market for you to day trade. Stay away from day trading in the Singapore market unless you are using highly leveraged instruments where you can just capture a few pips difference or few ticks difference, and that will make your day. All right, so personally, I do not like to trade so big. I like to trade with a more sound psychology. My account is not that big as well, so I prefer to do day trades when the range are really favorable, where we are looking at a 1% range minimally. All right, so with this said, now what is going to happen to the US market, because this is what I specialize in, the US market. So on the US market, what it has done, it came down since the 29th of July, and in the whole of August it has been coming down, bounce up to the high of 2940, come down again, and right now it's in the middle of nowhere. So it makes the obvious sense to tell you, or even you can see it, that the upside remains 2940 over there, and the downside remains at 2840. So we are trapped within a 100 points range on the S&P 500 in this coming week. And I'm seeing some form of buying over here. So there are some form of demand in this zone. So around 2840, there should be some buyers. So in the event that it comes down again and I'm not spotting any buying pressure, then where is the next downside? The next downside would be the round number, which coincides with my trend line as well as the S5. So it will go somewhere in between 2,800 plus minus 10 to 15 points. And this is the further downside should I never see 2840 being the area of buying. Okay, if I don't see buyers coming in at that price point, then I gotta be worried. I will have a further downside, which is around 2,800 points. So in the event that the market just does a first bottom, a second bottom, and bounce all the way up, where's the upside? Well, the first target would be S2, which is just here at 2910. Second target 2940 for the coming week. So with that said, right, am I being bullish or am I being bearish? Personally, I'm still being bullish on the US market, on the equity market, despite what the rest of the people may say about the yield curve. So this week, what I'm going to look at is also to address the yield curve. Well, this is the dynamic yield curve that you can get freely from stockcharts.com. And usually what happens with the yield curve is, if you look at the change of the curve, it goes from normal, okay? So it goes from normal to flattening and to inverted, and thereafter a market crash. So there is always three stages when it comes to a yield curve: normal, flattening, and then an inversion. Before 6 to 12 months later, more like 12 to 18 months later, the market will crash. So what am I looking at here is, well, if you just look at the shift of the yield curve, nothing much. It is just flattening. So when it is flattening and people are also concentrating on the 2 years being inverted with the 10 years, you can see that the 2 and 10 years, they are not permanently inverted. They are just shuttling in between. Okay, normal, inversion, normal, inversion, normal, inversion. So that's what's happening on the 2 years and 5 years. So with this said, what I want to do is to track back to the start of 2019. So the start of 2019, you can see the 10 years was here, and then the 30 years yield was here. Okay, and moving forward, few months later, this was sometime in April or May. You can see that the broad market, it is still in a very risk-on mentality. In a sense, people are still not buying in the treasuries. The yields remains relatively stable. And you can see that this one, fast forward into May 2019, where you look at the date over here, the yields are still pretty much the same, except that you can see people are shifting the money into the 10 years. Okay, so I have the 2 years over here. So the 2 years remains at 2.32. So this was in May, this was in January, this was in January. So now let's look at what happens now. Can you see a broad shift or a broad drop in the yield in the bond market? So what does this signify? Well, first thing for a start, is this the end of world? No, I do not think that this is the end of world. But what I do think is that there is a start of a risk-off mentality by the market participants, which is evidently seen here because you can see that money is flowing out of the equity market with the trade war going on, with all the yield curve inversion, with all the fear-mongering headlines. What are people going to do? What are the, how are the institutions going to react? So they cannot take out their money like retail traders. Well, we don't trade, we can keep cash. For them, they can't because they are holding billions and trillions of dollars. So what do? They either hedge or they shift their money into something safer. So in this sense, you can see that they are shifting the money into bonds, the 10 years, the 2 years, and also some of the 30 years. And I would think that most of the banks, they will be looking at the 10 years because that is like the sweet spot among the horizon. 30 years is too long. 30 years is the one whole generation, is too long. But 10 years is the sweet spot. 3 months, 2 years, kind of short. All right. So what we are looking at here is a broad drop in the yield. And this is what I am looking at more so as compared to this small inversion between 2 years, 5 years, or the 2 years, 10 years. Okay. So a drop in the yield signifies a flight to safety, signifies money flowing into the treasury market. And that's why prices of the treasuries have gone up. That explains why the yield has dropped. Okay, so this is why I think that this is a start of a risk-off mentality. But right now we are at a very, very starting of it. And if you are like panicking, selling everything, holding cash, waiting to short, it may be a little bit too early. All right. So with this said, let's look at what are the sectors where it generates. It can give us some strength. So first thing first, this is how, since the drop on 29 July, this is how the S&P 500 has performed. It has dropped around 4%. So which are the sectors, if you draw one line and do a strike through, right? Which are the sectors that are best performing? Which are the sectors that are underperforming the market? Well, it's pretty clear cut, isn't it? So obviously, the sectors that are, showing some strength is definitely in utilities. And that is the only sector after the market crash that has remained positive. And it makes perfect sense because this is a defensive sector. All right, so utilities is showing some strength, and then the next one is staples, which again it makes sense because this is a defensive sector. This is a defensive sector. Be it whether there is recession, you still need to eat, you still need your shampoo, you still need all the things that keeps your life going, right? And then the next thing is healthcare. That is the third leader, and then followed by materials. And there's no surprise that consumer discretionary is the lagging one. Energy is lagging. Well, that's surprising. And then financials are lagging, industrials are lagging, and then technology is lagging. So this is where or how you can generate trades. Because if you are just looking blindly, not knowing what to buy, then you're in for a rough ride, isn't it? But if you want to know where the strengths are, look for the stocks inside the utility sectors. The top 10 holdings of the utility ETF, XLU, go check them out. They must be exhibiting some strength. So the winning stocks that I've been taking with my community of traders for the last 2 weeks have all been in the utility sector. All right. So there are some strength that are going on here. And then also check out staples. So if you're telling me you do not know what to buy, do not know where to park your money, look at these two sectors, for crying out loud. These two sectors, if you do not know what to buy the ETF. All right. So you can see that right now, so far, what have we discussed? We have talked about a risk-off mentality. We have talked about the turning points of the market in the coming week, as well as where are the strengths. And look for the strength. We always seek to buy strength and sell weakness. If you are looking to short sell, then of course, by all means, look at energy, look at discretionary, look at technology, look at financials. These are all four very good, very good sectors that will give you a very weak stocks. So all those weak stocks, you should short them. Okay, when you have a setup, it fulfills the setup to short it. Go ahead, short them in these sectors. You do not short something that is showing strength, like utilities. Okay, so this has always been my philosophy when it comes to trading. In a sense, I am a trend follower, and I follow where the strength is. I follow how the market goes, where the money flows. Because trust me, in a sense, whether you believe it or not, even if I gather 10,000 of me all along together with all my traders, we pool all our money together, we still can't even beat one institution. So since we cannot affect the market, might as well we just follow what the market does, right? Okay, so this is what I have for you in this week. So check out the strong stocks, check out the turning points, and I wish you a very safe trading week ahead, and I will catch you soon.